Is there going to be an AI bubble? This is the question I have been getting for at least 6 months, if not a year. There have been tons of articles written about this. I should know because I feel like every single one of them have been sent to me to ask my opinion on what they're writing about, which is totally fine. I have no problem with that. But this is a topic that people are very worried about, and I think is worth having a discussion over. Is there going to be an AI bubble in the market? And how do we prepare for it? So, if that sounds interesting to you, stick around. That's going to be our topic. First and foremost, I just want to welcome anybody new here. I'm Lisa, I'm a financial advisor, and I have been doing this for about 15 years, helping people get to financial freedom as quickly as possible. And if you are a returning viewer, we're so happy to have you as well. Okay, so we're going to go into the AI bubble. We're going to discuss this. There's going to be a lot of AI topics. I'm calling them AI in your money topics this year because AI is just becoming more and more encompassing in our world, not just when it comes to the financial markets and the economy, but also it's going to start to drip into your everyday life. And you are going to have to know how to handle AI kind of intruding on what we know as simple, save here, buy this, do this, the typical finance stuff is going to get changed quite a bit. So I do think that AI as a topic is going to be, rampant all over the place. But when it comes to your money and financial decisions and how you utilize AI to your advantage and what things you need to watch out for when AI is starting to make shopping choices for you or whatever else comes down the line, that is what we are here for and we're going to be discussing. But today it's going to be about the AI bubble and the stock market in particular. Now, for most people, they don't really know what a bubble means. We hear it, we kind of have an idea, but we don't really know what it means. So let's actually define what a bubble in the market means. So it means that prices are rising faster than the real economic value. And you've seen this probably before. If you've watched any of those television shows on where the entrepreneur walks in, there's all these investors sitting there and they present their valuation for their company. And then the investors say, that's not true. You're looking at it wrong. And the entrepreneur says, no, I'm looking at it this way. The real economic value and the valuation or the price is, it's up for debate. Let's be honest. I know that people don't like saying that, but it is. It's up to interpretation of how you look at valuations. So the idea of a bubble in general is kind of silly. What they're really saying is the market going to go to a downturn or for all these articles, crash? I don't know what that means, but is the market going to go in a downturn spiral because of AI, just like it did for the tech bubble in the early 2000s? That's what the question really is. Okay. So don't worry about bubble and all this stuff. Just think, is AI and the growth of AI and how fast it's growing, is it going to affect the stock market in a negative way in the upcoming year or two, or 3 or 4, or however many years down the line we're talking about? And I don't blame people because this tech discussion, everything tech, we've got the .com boom and we got crypto and we've got EV hype and all that stuff. It just seems to be overpowering. And AI has been slowly but surely just kind of being a fundamental growth of that kind of conversation over the last 5 years at least. And so let's discuss, is there a case for an AI bubble? Is there a case against an AI bubble? And what I think at the end of the day. Now, just because there might be a bubble, meaning the market might take a downturn because of AI or because of AI companies, I should say, not because of AI, but because of AI companies, doesn't mean that AI won't be here, won't be transformative, won't be part of our future. That's not what I'm saying at all. I'm just taking a look at, in the shorter term, I would say probably the next 5 years or so, are we going to have, a big downturn in the market because of these AI companies, just like we did with the tech bubble because those tech companies are still around, right? There's plenty of them still around. So that's what we're taking a look at. And before we kind of get into this, there's this kind of, we can focus on one real reason that the market's down or that this company did whatever. Look, it's historical. Every few years, there is typically a downturn in the market. It just happens. We oftentimes want to attach a reason to it. Sometimes there's a reason, sometimes there's not. Sometimes the market is just has a downturn. The economy is not great. People, just things happen. And that's okay. That is normal. There's normal cycles in the market. And you should be prepared for downturns in the market as well as good years like we had in 2025 and in 2024. So you just don't want to get into a panic about downturns because they are part of the natural cycle of investing. They just are. And they're not going anywhere. So we need to just keep that in mind. But AI is interesting. So let's talk about that. Okay. So what's the case for an AI bubble? The for is very reasonable and is going to be much more easy to understand than the against the AI bubble case. So let's go through the for an AI bubble. First and foremost, a lot of these companies do have very high valuations. Are these valuations really propped up by great profits? Some of them are, some of them aren't. And AI is new and it's interesting and it's different and it's experimental. And a lot of times experimental companies tend to get a higher valuation for whatever reason. People are trying to get in the bottom floor of it. And they're trying to, be with a company that's going to rise up and be successful so that they make money too, right? That's logical. That's what happens in this society. And so, we do have very optimistic views on AI. And so a lot of money is pouring into that. And maybe it's going in a lot quicker than the actual profitability or the actual valuation should be for these companies, right? And so that also creates this herd mentality. Like everybody says, should I be in it? Should I be going this direction? Maybe I should be in this. Maybe I should be in this stock or in this stock. I heard about this stock. My friend told me about this stock, and so people start to go off of past performance on a stock or something they heard versus an actual fundamentals viewpoint of things. And that can be a problem, right? Because people are making choices out of emotion rather than out of logic, which unfortunately happens a lot in the markets. Another thing is, tech does tend to repeat itself. And we've gone through a bust essentially in early 2000s. And many companies failed in the tech space. They had huge valuations, lots of backing, lots of money in them in the stock market, and they fell apart. They didn't make it. And so, that happens in every industry. That could happen in healthcare or oil or retail. I mean, it could happen with any of them. But, when it's all concentrated in one area, like technology or like AI, that's when that bubble phenomenon kind of burst bubble kind of happens, right? But just remember, tech is still here. I mean, I'm using tech to do this video. I'm using tech to look at my notes on the side. We have tech everywhere. And so it didn't fail. It just meant, that there was a certain number of companies that didn't make it. And that happens a lot in like I said, in every sector, really. So it's very similar that could be happening in AI. All these AI companies pop up and a lot of them are not successful and a handful of them are. That is very possible. And not all AI companies are cashing in yet. Like they don't have huge profits going on, just like what happened during the technology bubble and bust. And the infrastructure is so much more expensive than it is for technology. Technology was, a lot of .com things, a lot of guys and gals, I should say, sitting on their computer, coding, doing things. So that's a lot less money going into those, companies for that kind of process. AI in general is very expensive. You have to have a lot of energy, you have to have a lot of machinery, you have to have a lot of stuff going on with it. And so the costs are very high on that. Um, and so essentially, I could see why people are a little bit more nervous about this than necessarily the tech bubble. So that makes sense why that's possible, that there could be an AI bubble brewing. Now, let's talk about why this might not be a bubble and what the differences are from this to maybe the tech bubble burst in early 2000s. So, companies are AI is being infiltrated into not just AI companies, but to plenty of other places out there. You hear it in banks and different sectors that are including AI in their everyday transactions and systems to increase output. And so AI itself, these AI companies that are creating AI and providing it other places, is helping other company, or I should say, are helping other companies, right? So it's not just affecting AI, it is more universal. Whereas I was a teenager when the .com stuff and all that stuff started, and I don't know if people were really utilizing it as quickly as companies are utilizing AI. So that's one thing that could help because it's a little bit more spread out. There is also plenty of companies in this space that are very profitable. You've got data centers and chips and energy companies and cybersecurity companies. These are real revenue drivers. They already have companies that are profitable and they all surround and make up AI. There's not, I guess there are some companies that are just AI focused, but a lot of them are other kinds of companies that are starting to move into this space. And so a lot of these companies are very profitable already have a footprint in an area that are just kind of expanding into other areas, which is different than just some like guys that popped up and started a company, right? Also, this, we kind of touched on this already, but AI is adoption across all different industries. So you've got healthcare and finance and legal, marketing and manufacturing. The broad demand creates a little bit more stability than I think what was happening in the .com part of things. And then, like I said, we have strong earnings from some key leaders that are already big companies that were already driving the stock market before AI really kind of took over the scene. So there might be hype, and because the term AI is new and the technology is kind of new, people think this is new, but there's still real economic weight in AI, meaning that these companies, a lot of them are very established companies. And so I do feel like it could be very different. So AI can be a hype, it can be, but it's still going to transform the economy quite a bit. And so both can be true. We can still have some stocks, some companies that are overvalued, but have overall technology reshaping things and the expansion be so big and the types of companies involved being so much bigger and more established than it was during the .com and the tech stuff over in the beginning of the century, that it could be a very different outcome. Does that mean I think it's just going to go straight up? No, I don't think that. We are going to have times of downturn in the market, and it could be the cause of these AI companies. But I don't necessarily think it's going to be the same kind of pop that we felt in the tech side of things. And it could be worse actually, because it could be across so many different sectors, it could be worse actually. But I think the biggest things to consider when you're looking at something like this, because even though I think this is very different than the crash in the early 2000s, I think you have to take a look at, okay, it's different, things are different, but how do we prepare and make sure that we're ready for when that downturn happens, whether it's AI based or not? Okay. One is to don't chase hot stocks. That's the thing. I always get a call from people and say, should I heard this, I heard that, I heard, and usually I hate to tell them, but if they've heard it or they read it someplace, it's probably too late to get the upside of what they're trying to accomplish. I might be wrong on that, but usually when we're trying to focus in on one company and trying to get the hot stock that, we buy at the base and it just skyrockets and we're multimillionaires from that, that doesn't happen that often. And so we really need to stop chasing these kind of hot stocks that we think are out there. And I would tell you, if you're in mutual funds or if you're in ETFs or funds out there, most likely you already own it. Like I had people calling a year or two ago about a certain company. I'm not going to name the company because I don't want to seem like I'm giving a stock tip or anything, but a certain company. And I would have to go through their funds and say, you already own it in this fund. Like, do we really need to buy it separately as well? Like you already own it in these funds. The funds the funds are usually following the trend. So you don't really have to if you're in diversified funds out there. So just keep that in mind. And you honestly could be taking on too much risk in that company. If the fund owns a certain amount and then you own a certain amount of a certain company, it could be too much, honestly, and be upping your risk way past what you think it's going to be. So stay diversified. Make sure that you're still exposing yourself in lots of different sectors. Does it have to be all sectors? No, but you want to be aware that there are plenty of other sectors that are out there and you want to spread that out across your portfolio. And I say not just sectors, but also countries. You want to do some international and some emerging and some, what percentages and how much you put in that depends on your situation and depends on your risk tolerance and all that stuff. But you do want to be well diversified because as we saw in 2025, international did great. But for many years before that, international had not done well. And all these people were saying, I should get out of international. I should do. And, calm and steady and being diversified will pay off in the long run. It just will. Okay. Dollar cost averaging. Stick with basics. Okay. So when I talk about dollar cost averaging, that means consistent investing. If you're already investing, just consistently invest. Stay the course. A lot of times with these kind of fads that are out there, and AI is not a fad, but talking about it like this is kind of a fad. You just want to stay with the basics and dollar cost averaging, the traditional investing, regularly and investing diversified is the way to get through a lot of these things. And again, you want to focus on long-term strategies. We're looking 5, 10, 20, 30 years out. Even if you're retiring, if you're 65, the chances of you living to 95 are much higher nowadays than they used to be. So you can have 30 years in the market, and people always look at that time and say, oh, short-term investing. It's really not. It's still long-term investing. And you never know. At 85, you might have 20 more years in the market, depending on your health and healthcare. And, maybe AI has changed things and people are living to 150. You just never know. So you want to always be looking long-term for many things when it comes to investing. Another thing is always be checking your risk tolerance, making sure you understand your risk, you understand the potential downturn risk, because obviously none of us have a crystal ball. I cannot tell people how much their account's going to go down in the next downturn, but we can at least discuss the historics and see how it did in 2022 or early part of 2020 or 2018 or whatever else down markets we've had. So we can still look at historics and use that to help us on risk. And then don't let the changing headlines necessarily make you change your course. Your course should be pretty steady. It doesn't mean you don't have flexibility in your planning, but you do want to make sure you still stay with your fundamentals and kind of push that noise away. Because as I talked about, AI is going to be across many different sectors, if not all the sectors at some point. And so you will be getting plenty of exposure. Let me just put it that way. So we don't build wealth by predicting bubbles, we really build it by clarity, by consistency, by staying the course, by keeping our head about us and staying actively involved, not meaning trading actively involved in understanding where things are instead of just saying, oh, I won't deal with it now. And then because you don't deal with it, then you're making uninformed decisions in a pinch, which is not a good thing to do. So AI may rise, it might pull back, it might surge again. It's going to be an up and down just like the markets. And so your financial freedom is really going to be built on the long term. So whether or not there's an AI bubble, it really shouldn't affect your overall planning. It's just a tool, just like everything else. So with that, I hope this helped you kind of stay the course, understand how AI can affect you, but also not be chasing the shiny object thing. Okay. So until next time, stay safe out there, stay strong, be kind to one another, and we will see you on the next video. Bye-bye.